All right, good morning, everyone. It is April 15th, and what was formerly tax day, obviously been pushed forward to July 15th at this point. But kind of an interesting day. Normally, this is the day when our office kind of starts calming down with the tax questions, and we can kind of take a huge breath of fresh air and a sigh of relief that tax season's over, but obviously that's not the case. But thank you for watching today. I'm going to fly through kind of a rapid fire list of charts and some things that I'd like to share with you about the state of the stock market today. I'm calling this From Fear to FOMO, in other words, from fear to fear of missing out in 37 days, because it really has been that fast. So again, I just appreciate you joining me here with my my black market haircut. And I'd like to thank her if she's watching. I won't out you and say who you are, but thank you for what felt like the best haircut in my life. So let's go ahead and jump forward and get started here. First thing, a quote from Walter Deemer, a legend in technical analysis and research, and he says, "The stock market will do whatever it has to do in order to embarrass the greatest number of people to the greatest extent possible." And the whole point here is that people will get married to and treat their investment decisions like it's their religion. And once they make a decision, once they have an opinion, they tend to follow that opinion, get married to that opinion, and they don't want to change their opinion. So in the technical analysis world and trend following world, we have rules that we put together. Every investor is different, or every professional is different. The way my rules work is I have 13 different indicators that I'm following, and those rules tell me what to do based on what the market is doing to those rules. So technically, it's the market telling me what to do. So I think you always have to be careful not to follow your opinion, but rather to make sure that the market confirms that opinion before you make any decisions. So let's jump into the charts here. First and foremost, quick chart of the S&P 500. This is the stock market with a declining 200-day moving average and a declining 50-day moving average. So declining 200-day trend, declining 50-day trend. And what I point out here is that we are about 1.5% to the 50-day moving average and about 5.9% to the 200-day moving average. So this has been a big bounce in a very short period of time. We're talking a 15-day rally is all it's been. And by the way, I recorded all of these charts, or I should say, I put these charts together, the slide deck, last night. So this is all based on closing market data yesterday. So obviously the market's down today. Dow's down about 500 points. So just keep that in mind as we go through these. So point being here, we're really closing in on these declining overhead potential levels of resistance or potential ceilings of resistance. And that's one reason why we might want to consider being a little bit careful here and not just assuming that this market's just going to keep soaring northward forever. The next one here is just kind of an example of the same two moving averages, but going back to the stock market crash in 2007 to 2009 during the Great Recession. You can see here how there's been several times where the market would go above even its 50-day moving average, but then smack its 200-day trend, again, declining 200-day trend, and then just bounce right off of it again and head lower. Here it barely made it above its 50-day trend, again headed lower. Same kind of thing down here. And if we want to look at the raw numbers, this was in my quarterly scouting report that we sent out. I believe it was last weekend or the weekend before. But this is the jumps that we can expect to see during a bear market or during a market crash. You can see here in 2007, 8, and 9, jumps of 12%, 12%, 18%, 24%. So these rallies can occur, faking people out and making them think that we're back in a positive trend and give you that, again, fear of missing out, of that FOMO effect. Next one I want to show you is the same exact thing, except now we're looking at 2000, 2001, 2002. So again, market goes down, bounces, gets smacked in the head by its declining 200-day trend line or 200-day moving average. Again, falls lower, gets smacked twice, heads lower. Right around here in this big circle, there might have been several people on Twitter or I guess, social media wasn't that big back then. But in either case, there was a lot of people probably saying, you know what, see, I told you so. It's going to come back. It'll be fine. And then it doesn't. It gets smacked back down again. And if you want to look at the numbers, here are the numbers for that same time period, just like I showed you the Great Recession. Here are rallies during that stock market crash of 12%, 19, 21, 21, 21. So big rallies that make people think or fake you out into thinking that everything's just fine. The second big indicator I wanted to show you, or not an indicator, but just kind of an observation, is that as of yesterday, the market bounced up to its 50% retracement of the initial waterfall decline. And to put that into plain English, basically it bounced halfway up its full decline, which is typically a normal place where we would start to see maybe some downside pressure or some selling pressure from people who want to take profits at the very least. So that is another piece of evidence that suggests that maybe you don't want to be chasing the market here. The market is obviously very extended in the short term. We've got a 15-day 50% retracement. That's really crazy. So I don't want to call it unprecedented, but it's a big move. So here's another thing that I've been watching. This is these two red horizontal lines mark the January 2018 highs and the September 2018 highs. And the reason why these are significant, and you can see how the market can bounce off these levels and head back lower again several times over the last 2 years, the reason they're significant is because the psychology behind them. People who invested their money at or around these locations in the market and history want to get their money back. So if somebody invested back here and they're seeing the market bounce, this would be a point at which maybe they'd say, you know what, when the market gets back up to this level where I bought back here, well, now I'm going to sell and get out because, I just don't want to take risk in this market. And so, again, another reason why we need to be careful as we start to see hit these levels here. There's a reason for all these levels. It's not just lines on a chart, by the way. Here's another one that's a little bit nerdier, but stay with me. This is a chart of the S&P 500 with momentum below it. When the market is in a bullish mode, in other words, when it's in an uptrend, what we want to see is RSI down here. This is 14-period RSI, 14-day RSI. We want to see momentum between 30 and 100, and that's generally what we saw in the early part of 2018 until the fourth quarter, at which point we started to see this range of 0, it literally never hit 0, but from 0 to 70. And you can see how that momentum regime shifted back northward here in February, March-ish, and we were back off to the races. And then all of a sudden, same story here, late February, early March, we started to see a hint that maybe things weren't going so well anymore. And where we are today is in this area that I would call no man's land. So although we've had, for the nerds out there, although we've had some positive divergences off this waterfall decline, I think it's important to understand that when we start to see momentum get up in this 50, 60, 65-ish range, this is typically, again, when we start to see selling pressure come in and smack the market in the head and push it back down again. So we just have to be careful here and not, chase these returns and chase the market higher thinking that this is the end and we've seen the bottom. We don't know. Nobody knows. Anybody who tells you that we've seen the bottom or that we're going to see another bottom or it's going to go lower, nobody knows. We just have to follow the trends, not predict them. Here's another chart, really interesting. Learned this from my friend Brian and Shannon at Alpha Trends. Just really, really cool. I think he invented this indicator. But this is, again, without being too nerdy, this is a volume-weighted average price or an anchored VWAP. And what it basically means to again, translate to plain English here is the dotted line here from the January highs is the average price paid for the S&P 500, or in other words, the average price paid for the SPY since January of 2018. So at any time we're above that blue dotted line right here, that means that people who bought back here are in the black. If we're below that level, that means they're in the red. They're losing money. Same thing here. September 2018 highs, I anchored the VWAP here, so volume weighted average price from September 21st. And again, you can see here how this level is right above where the market currently sat or closed yesterday. Obviously, again, market's down today. Dow's down about 500 points. And then we have the anchored VWAP, or the volume-weighted average price from the start of this year. So anybody who was invested or invested their money at the beginning of this year is currently in the red. So again, kind of like the levels I was showing you earlier, people don't want to lose money, and they want to, if they have lost money, then they want to exit their positions ideally as close to break even as possible. Now, obviously, they don't have a clue, nor does anyone else, whether we're going to get back to their break even. But when they start to get closer to these levels, you can see why maybe if I bought back at January highs, September highs of 18, or this year in the beginning of the year, maybe I'm starting to look at this area as a place where, all right, that's close enough. I think it's time to start selling. And obviously, the way the market works, it's very simple: supply and demand. If there's more buying pressure than selling pressure, price must rise. If there's more selling pressure than buying pressure, price must fall. It's really that simple. So I'm going to add one more here just for fun. This is the exact same chart as what you just saw a second ago, except the difference is we're looking at the anchored VWAP from election day. Now, what I find extremely interesting about this chart is we actually, this last few days, got above the average weighted price from election day. But what this tells you is that roughly the 2,700 level on the S&P 500, and anybody who invested money on election day is break even. They haven't made a dime. So again, one more time, anytime we see these levels, I think that they're potential levels of resistance that above which or near which investors might want to cut bait and trim their losses and just walk away and be in a safer position. Obviously, we have no idea how to predict the movement of or whether or not investors are going to buy and sell, but I think that we need to look at the weight of the evidence. Next one I want to show you is the messiest chart you're probably going to see me ever show anyone. And what I did here was I combined every indicator or every observation into one chart. And what you see here, again, real quick, 50% retracement, 1.5 to 6% within the moving averages. We've got the January 18, September 18 highs. We've got the anchored VWAPs, anchored volume weighted average price from election day, the January highs, September highs, and year to date this year. And you have this convergence of all of these indicators, all of these levels of interest, 200-day, 50-day moving average, all these volume-weighted average prices, the 50% retracement, and then again, no man's land with momentum here. And I think that people want to be really, really careful when uttering words like, hey, I think we should get back into the market, or hey, I think this is a great place to buy, or I don't want to miss out on this rally, or it's going to be a V bottom. We need to get back in because the market's going to V bottom just like it did in 2018 and 19. Be real careful, because anytime you say that you think something's going to happen, you hope it's going to happen, or you want it to happen, the market will probably prove you wrong, going back to Walter Deemer's quote. I don't want to be completely pessimistic here, so I wanted to show you one chart that actually is somewhat encouraging, and that is the VIX. The volatility index just measures fear. So it's a fear gauge. It basically, if it's going higher, then people are freaking out, and if it comes lower, then that means people are starting to calm down. So the fact that this is starting to come down, and yesterday it closed below the 50-day moving average or the 50-day trend of the VIX, this is encouraging. It's showing us that those crazy ups and downs in the market are starting to get a little bit calmer, and that's what we want to see. We want to see some normality come back into the market here, so we can actually make decisions that aren't based on people's extreme fear in either direction, buying back in or selling. Here's a chart real quick that I posted on Twitter the other day, and it was featured in the chart report. And thank you, Patrick, for recognizing the chart. I appreciate that. But anyway, what we're looking at here is the circles are the times when the percentage of stocks on the stock market are above their 20-day moving average. So if the 50-day moving average is declining and the market's trading below it, like it was back here in 2018 fourth quarter a couple times, but we get a spike in the percentage of stocks on the market that are above their 20-day moving average, it tends to share a signal that maybe we're having some washed out conditions, some extended conditions. So we had it happen a couple times back here, November, December of 2018, and we're seeing it happen again today, and obviously, or I should say yesterday, and then obviously today we're seeing the market head lower. So I think that this signal is actually being confirmed as we speak. One last somewhat nerdy chart here I would like to share, just because I've shared this before. I shared it in my quarterly scouting report. This is above here in the top. This is the stock market S&P 500 candlestick chart with, again, declining 200-day and 50-day trends, or 250-day moving averages. And what we see below is kind of a slower indicator. So before, in the previous chart, I showed you the percentage of stocks in the S&P 500 that are above their 20-day moving averages. This is the percentage of stocks that are above their 200-day moving averages. And you can see for large caps, so this middle pane right here, this is large cap stocks, so the big ones, the big blue chips, only 17, call it 18% of companies as of yesterday were trading above their 200-day moving average. Obviously, it should go without saying that's kind of going to be the case considering how bad that waterfall decline was. The market crashed in record fashion. I'm not going to get any more into that. I'll just move on here. But anyway, the mid-cap, so mid-cap 400, so on the mid-cap indices, Only 13 to 14% of stocks trading above their 200-day moving average. And then last but not least, the small caps, so the risk appetite stocks, if you will. So in order for us to see a really great bull market and a bottom, we want to see the small companies being bought, and thus we want to see those prices going up, not sitting down here in the basement at these weak levels of 9.7% and not improving all that much. So real quick, just a quick summary of my trend model. Where I'm at right now on the left here is I have 4 price and trend indicators that I use, then I follow on a daily basis. All 4 are negative. And then I have 9 vital signs, I call them, but they're breadth indicators. They're basically, if you think of the market like a patient, like a doctor's patient, these are the internals or the vital signs inside the market that you can't really see just by looking at what the S&P 500, the Dow, is doing on any given day. And all but 2 of those are negative, so we're not looking at really any reason to be jumping back into the market here just yet. So, and again, just want to be clear, I'm not a short-term investor. I'm not a day trader. I'm more of an intermediate term trend follower. So if you're a day trader, then perhaps you think that the trend has been up for a while. But I can tell you from personal experience, some of my friends who are some of the best, most reputable short-term traders in the industry, they're not even buying here right now because things have become so overextended. On the right here, this is just an asset class ranking. This just ranks on a relative strength basis, the best to the worst asset class in the market right now. Obviously, money market, cash is number 1. Fixed income or bonds is number 2. Foreign currencies is number 3. And then the United States here in the domestic stocks are sitting in the 4th place position, which, again, isn't all that encouraging from a long-term perspective. So with that all being said, just real quick here, wanted to share with you something again, this continuum of investor behavior. The way the market works, it's all psychology, ladies and gentlemen. It's not earnings. It's not whether or not Apple sells a lot of Apple Watches this year. It's about whether or not people buy or if they sell, and then how much they buy or sell when they're buying or selling. So if this is obviously not a real stock chart, but if the market goes up like it did and peaks in February and it comes down and then we get this kind of 50% retracement and people start thinking things are back to normal, everything's fine, we're heading to new highs, and then we see it decline, we don't know what's going to happen. Again, we just have to react to it. We have to adapt. But this is where things can get a little dicey. So feel free to give me a call or shoot me an email if you have questions. But this is something that I think that we all need to understand, is that psychology runs the market, not earnings, not companies or anything like that. So just to kind of in conclusion here, in order to get back to a new normal, again, we have to recognize that the intermediate and long-term trends are down, and thus they are guilty until proven innocent and not the other way around. I'm not chasing this market. Again, it's very extended in the short term. There are going to be huge, on the positive side, there's going to be huge opportunities to participate in the new bull market once it begins. The thing is, it just hasn't begun yet. We have to be patient. So we need to see the market's vital signs recover and don't have FOMO. Don't have that fear of missing out. Honestly, I don't watch the financial news. Go outside, go for a walk, relax, do something with your family, and try not to worry about your money, because worrying about chasing the short-term trend is a good way to get, an ulcer, if not worse. So thank you so much for watching. This was a little bit longer than I wanted it to go. You can contact us here at our office, info@libertaswealth.com. If you want to follow me on Twitter, I can be followed at Adam Koós. You can follow our company, Libertas Wealth Management, on Twitter as well. Instagram at Financial Surgeon, and then on Facebook at facebook.com/Libertas Wealth. Thanks so much for watching or listening, and I'll look forward to hearing from you soon.